Warren Buffett has been investing for over 70 years. His net worth sits above $100 billion. And for most of that time, he lived in the same house he bought in 1958 for $31,500. That is not a coincidence. That is a philosophy. Most people think Buffett's success comes from picking the right stocks at the right time, from being smarter than everyone else in the room, from having access to information the rest of us do not. None of that is true. Turns out, the actual strategy is something most people could learn in an afternoon. The problem is nobody teaches it, not in school, not at work, not anywhere most people spend their time. There are 7 specific principles behind how Buffett built one of the largest fortunes in history. They are not secret in the sense that nobody knows about them. They are secret in the sense that most people hear them, nod, and then go back to doing the opposite. By the end of this, you will know exactly what they are. And more importantly, you will understand why knowing them is not enough. What actually matters is what you do differently starting today. The first secret is so simple it sounds like bad advice. Save consistently, not aggressively, not dramatically, just consistently. Buffett has talked about this more than almost anything else, not because saving is exciting, because without it, nothing else works. You cannot invest money you do not have, and you cannot have money to invest if it disappears before you get a chance to move it somewhere useful. Here is something worth thinking about. Studies of lottery winners consistently show the same pattern. A significant portion of people who receive large sudden windfalls return to their previous financial position within a few years. Not because they are irresponsible, because they never developed the habits that make wealth sustainable. The money arrived without the system to support it, and without the system, the money leaves the same way it came. This is what Buffett understood early. The amount matters less than the habit. A person who saves consistently on a modest income will build more lasting wealth than someone who earns significantly more but has no system for keeping it. The mistake most people make is trying to save too much too fast. They set ambitious targets, hit them for 2 or 3 months, then fail once, feel like they have broken something, and stop entirely. The habit dies before it has a chance to compound. The smarter approach is smaller and automatic. Take 10% of whatever comes in and move it somewhere you cannot easily touch before you spend anything else. Not after, before. If that feels like too much, start with whatever does not feel like too much. The number matters less than the consistency. A small amount saved every month for 30 years builds something. A large amount saved occasionally builds almost nothing. Buffett himself started at 11 years old with a few dollars. The amount was irrelevant. The habit was everything. The second secret is what Buffett calls value investing, and it is simpler than most people make it sound. Every company has 2 numbers that matter: what it is actually worth and what its shares are currently selling for. Most of the time, these numbers are close to each other. Occasionally, they are not. And when they are not, that gap is where the opportunity lives. Think of it this way. If someone offered to sell you a $1 bill for 75 cents, you would buy as many as you could. Value investing is exactly that. Finding companies where the market price is significantly below what the business is actually worth, buying them, and waiting for the gap to close. The difficulty is not the concept. The concept is straightforward. The difficulty is the patience required to wait while everyone around you is doing something noisier and faster and apparently more exciting. The third secret is the competence circle, and most people violate it constantly without realizing it. Buffett does not invest in things he does not understand, not because other things are bad investments, because he cannot accurately evaluate what he does not understand. And if you cannot evaluate something accurately, you are not investing, you are guessing. Your competence circle is the area where you actually know things, where you work, what you buy, what industries you understand from the inside. Start there. What companies make the products you use every day? What businesses operate in the field you work in? What services do people around you consistently pay for without complaining about the price? That is where your research starts. Not with whatever is being discussed loudest right now, with what you actually know. The fourth secret is what Buffett calls the economic moat, and it is one of the most important filters for deciding which companies are worth owning for a long time. An economic moat is whatever protects a business from competition. A brand so strong that people pay more for it without questioning why. A cost structure so efficient that competitors cannot match the price and still make money. A product so embedded in daily life that switching to something else creates real friction. Think about the companies whose products have become the default word for the thing itself. When a brand name replaces the category name in everyday language, that is a moat. These companies tend to survive recessions, cultural shifts, and competitive pressure in ways that businesses without moats simply cannot. The question to ask before any long-term investment is this: what would it take to put this company out of business? If the answer is very little, the moat is shallow. If the answer is almost impossible to imagine, the moat is deep. Buffett wants the deep ones. The fifth secret is understanding the language of business, which means reading financial statements. Most people stop here. The words feel technical, the numbers seem complicated, but the actual concepts are not difficult once you stop being afraid of them. Three documents tell you almost everything you need to know about a company. The balance sheet shows you what the company owns and what it owes. The difference between those two numbers is its real value. Look at the debt to equity ratio. A company carrying more debt than equity is walking a tightrope. A company with manageable debt relative to its assets has room to absorb bad years. The income statement shows you whether the company is actually making money. Focus on the return on equity. Take the net profit and divide it by the shareholders' equity. Anything above 15% consistently is a strong signal. Below that, keep looking. The cash flow statement shows you whether the profit is real. A company can report profit on paper while bleeding cash in practice. Consistent positive cash flow over multiple years is one of the most reliable indicators of a healthy business. None of this requires an accounting degree. It requires about 30 minutes of focused attention on the right numbers. The sixth secret is the net-net method, developed by Buffett's teacher Benjamin Graham, and still one of the most powerful tools in value investing. The idea is to find companies where the current market price is below what the company would be worth if it were simply liquidated, shut down, sold off piece by piece. To calculate this, take the company's current assets and subtract all its liabilities. That gives you the net current asset value. Then divide by the number of shares outstanding. That gives you the per share value. If the current share price is below that number, the stock is trading for less than the company is worth, even in a worst-case scenario. Graham believed the best opportunities came with a safety margin of at least one-third below that value, meaning you are not just buying something cheap, you are buying something cheap with room to be wrong and still come out ahead. The seventh secret is portfolio management, and it is where most individual investors quietly destroy the returns they spent years building. Buffett said something worth remembering here: diversification is protection against ignorance, not a strategy for maximizing returns, a strategy for surviving the inevitable moments when you turn out to be wrong about something you were confident about. In 1969, Buffett did something that confused almost everyone watching. He stepped away from the market entirely. He looked at what was available and concluded that everything was overvalued. So he waited. Between 1971 and 1974, the market dropped sharply. His capital sat untouched while others lost significant ground. When prices came down to levels that made sense, he was ready to move, while most people were recovering from damage they had just taken. Discipline includes knowing when the right move is to do nothing. 5 rules matter for managing a portfolio well. First, decide how much you are investing before you start and stick to it. Second, never put more than 10% of your portfolio into a single stock. Concentration amplifies both gains and losses. At this stage of building wealth, avoiding catastrophic loss matters more than maximizing any single win. Third, rank your holdings by confidence. The companies you understand best and believe in most should receive the largest allocations. Fourth, review your portfolio at least once a year. Read the annual and quarterly reports. Look for trends that concern you. Adjust when the fundamentals change, not when the price moves. Fifth, do not sell just because the price drops. A great business having a bad quarter is not the same as a great business becoming a bad business. Buffett buys more of the companies he believes in when their prices fall. That is the opposite of what most people do. Here is what these 7 secrets have in common. None of them are complicated. None of them require special access or privileged information or unusually high intelligence. What they require is consistency, patience, and the discipline to keep doing boring things for a long time while everyone around you is chasing something faster. Buffett did not build $100 billion by being the smartest person in the room. He built it by understanding a small number of things very well and applying them without stopping for 7 decades. The strategy is available to anyone. The results depend entirely on what you do with it. Most people will finish this video, find everything reasonable, and change nothing. They will go back to the same habits, the same accounts, the same patterns that produce the same results. Not because they disagree, because the gap between understanding something and doing something about it is where most good intentions go to die. A smaller number will take one idea from this and apply it this week. Open the account, move the 10%, look up one company they already understand. Just one thing. That one thing, done consistently, compounds into something unrecognizable from the starting point. Buffett has one more thing he says that most people hear and immediately forget. Someone is sitting in the shade today because someone planted a tree a long time ago. The tree does not grow overnight. It does not grow visibly for a long time, but it grows. And the people who planted it anyway, without being able to see the result while they were doing the work, are the ones sitting in the shade. The question is not whether the strategy works. The question is whether you will start planting today.